Hello and welcome to another fantastic week of Angel Insights brought to you by SyndicateRoom, the show that delves inside the world of angel investing to reveal their tactics, tips and strategies when it comes to investing in startups. And joining us today is David Ford. David has been an active investor in the public markets for many years. However, in the past 12 months, David has been gaining experience angel investing in a variety of startups from the 2 to 10 million valuation range. Prior to becoming a full-time angel investor, David worked for a leading global leveraged finance investor, backing a variety of LBOs and investing across a range of asset classes, including senior debt, high-yield bonds, and PIK securities. He was latterly head of credit research for Europe, as well as sitting on the European, AsiaPacific, and US investment committees. But David really got a taste for the tech ecosystem in the early 2000s when he was on the secondment to the San Francisco office and experienced firsthand the boom and bust of Silicon Valley. So without further ado, I'm delighted to welcome the man himself, David Ford, angel investor. David, welcome to Angel Insights. Thank you so much for joining us today.
Not at all. Good to be on.
Now, can you kick off the show by giving us a little background about you and telling us how you made your entry into the investing world?
Yeah, of course. So I left university almost 20 years ago now. And, as you do, you look around for career opportunities and the like and spent quite a lot of time, interviewing and really liked investment management, the asset management industry, because I think it gave you the opportunity really to dig into companies. Make money, yes, but really dig into companies, develop good relationships, and really sort of put your knowledge to work, if you like. Mm-hmm. So I entered the investment management industry at that point in time. Have really continued to develop my career since then, sort of investing across different asset classes, both public and private markets. Had a stint for a couple of years in San Francisco during the tech boom of the early 2000s. So that was certainly a very interesting time.
Yeah, how was that? How was that being there, experiencing it?
Yeah, I mean, I wasn't investing in tech specifically. I was actually backing more SMEs, so not so much startups. More SME style debt financing. But to be in a place which is undergoing a very, very aggressive big boom was fantastic. You go in, people you meet in the street, it's the US, so everyone's a lot friendlier and a lot more sort of effusive and you're talking about what they're up to anyway. So you're talking to sort of or strangers in a cafe or bar or whatever, and everyone seemed to be involved in tech at that point in time. I imagine it's even more so now, but certainly very interesting. But I was there through the sort of boom and then actually the bust as well, so you actually can see what can go wrong for a lot of these things, which I think is a reminder and a lesson to be learned as well. And you see the impact that actually the bursting of that bubble had on the city of San Francisco was fascinating as well, in terms of what it meant for things like taxi drivers in the street and restaurants, cafes, etc. So fascinating time to see it right through the peak and then down into the doldrums, so to speak. But the last 12 or so years, I've been investing in private equity buyouts, leverage buyouts, which actually I think is a very good grounding for angel investing. Very familiar and used to sort of running due diligence processes, sitting on boards, sitting on investment committees. So as I've considered, as you do, you look around for your next career move, angel investing actually for me was something I'd been doing a little bit on the side with colleagues and friends, as a sort of sideshow, if you like, from an investment perspective. But actually, in thinking about the next career step, actually to be able to focus more on a full-time basis on angel investing actually seemed to me ultimately to be the natural next step. So to do that, I actually took the decision last year to step away from a full-time role with my previous employer, to spend more time on angel opportunities, because actually what I found is that I'm sure we'll sort of come on to discuss lessons learned and the like. But one of the biggest constraints actually is just the time to look at opportunities. So the idea of, and that's not necessarily compatible with a regular sort of full-time role.
Absolutely. And so, in terms of when you were working and doing it on the side, what was your deal sourcing like then, and how has it changed now that you're a full-time investor?
Yeah, I think, the great development, I think, over the last number of years has been online platforms, which does make it easier to access deal flow than perhaps it once was. So I think that's certainly very helpful. So that has been that to date has been a key source of deal flow for me. But from that comes contacts, comes networks and acquaintances, and so you're building up a network of contacts, which just allows you to see more deal flow and really appreciate, I think, what the opportunity is, which is probably far vaster than I initially thought, in terms of the number of angel networks out there, some very niche angel networks out there, some very sort of long-standing, well-known networks. But I think the more you scratch beneath the surface rather, the more you realise actually there are a lot of these deal opportunities. But having more time to look at them means actually you can just spread that net a little bit wider.
And you mentioned there angel networks. Is that the biggest surprise for you in entering the industry, or are there any other surprises that you weren't expecting?
In terms of surprises, I think it's a positive surprise. One of the biggest, rather the single most pleasing thing I think I found out about angel investing is that everyone is incredibly generous with their time, with their advice, with their contacts. There's no view that I'm talking to you, therefore you might be a competitor. I think everyone really buys into this idea that the development of the angel investing scene, the infrastructure behind the deals, is in everyone's interest that we build this ecosystem, if you like. So I think that's been the single most pleasing thing, is that when I talk to someone and say, who else do you think I should talk to? And I'll say, yeah, you should call this person. I'll send them an email and make the intro. So what I found is almost this sort of exponential growth in network, which has been probably, if I'm honest, far easier to develop than I might have expected coming to the area cold.
And how have you harnessed that? Was that through initial contacts, or was that through going to meetups and the networks that we just spoke about? How have you cultivated the great network around you?
It's a little bit of both. So I think it is absolutely, joining a formal network and going to slightly more formal pitch events where you might see anywhere from 5, 10, 15 companies pitching at various lengths of pitch. But generally, it's your opportunity to meet with entrepreneurs, meet with the sort of wider angel network. So that's absolutely one area of building out the network. But then it is as being diligent about following up on conversations and going for coffee with someone, and just over time building that trust, building that faith in a network. Because ultimately, I think we are investing in deals for the most part as part of a syndicate, and I think having the faith of the people around you, or the faith in the people around you, is actually very important when we think about the sort of longer term or medium term development of companies. You want to be doing deals with people who you know and you trust.
And we mentioned the change in deal sourcing as you've transitioned from part-time to full-time angel. How's your strategy then? Has your strategy changed with the change of industry for you? Has that altered dramatically?
I think one in terms of strategy is how I've approached transactions. I've to date have taken a relatively passive role in deals, coming in absolutely behind a lead investor. Now I have the time to do so, absolutely thinking of moving into that lead investor role. And because I have the time to do it, I think I have the background to be able to do that. But it is a time commitment, and it's a real time commitment, and it's important for the syndicate behind you. And I think it's also important from an entrepreneur perspective, the founder perspective, that if you're going into that role, you're going into it with your eyes open and you have sufficient time to be able to commit to that particular opportunity. So that's probably, from my perspective, the biggest shift is the way I've approached transactions, from that move away from passive to hopefully more active opportunities. But I think that's clearly not for everyone. From chatting to a lot of other angels, some people are very happy being that sort of passive role, but coming in behind a more active lead. But someone absolutely they have faith in and have that sort of that face-to-face contact on a regular basis.
And what attributes then do you think are required of a great lead? Is it it's because it's not time alone, is it? What would you say it is for you that makes the great lead?
Yeah, I think I think there's clearly a technical knowledge requirement there in terms of ability to think about negotiating shareholder documents, so thinking about the sort of legal aspects of the transaction, thinking about valuation and how, certainly on sort of add-on rounds for future financings, how valuations have developed. So I think there's certainly a technical knowledge underlying it as well. But I think, and this is slightly more nuanced and a slightly intangible sort of factor, if you like. I think it sort of depends to me where the company is in its life cycle. I think if you are thinking about, the company's thinking about, okay, it's fundraising and thinking with one eye on an exit at some point in the future, I think that's a different lead. There's different requirements of the lead to say you're building a company up. You need someone with specific industry experience on the board, or as the lead, bringing in their own industry contacts. So I think it sort of depends where the company is in its life cycle, because I think what makes a good lead for one company doesn't necessarily make them a good lead for another company.
Absolutely. And you mentioned their valuation. It's often a widely debated topic. We have tech valuations, which may be 10x revenue, and then you see Dragon's Den, for our US listeners, Shark Tank's the US equivalent. And they much prefer to go on the standard 2.5 times. Where do you fall on the valuation? Do you have a formulaic response to it, or do you do it case by case?
I do very much case by case. I mean, I think you're absolutely right. The sort of single biggest concern probably I have today, and in coming into the industry in the last 12 months or so, cold, if you like, is the froth in valuations, and really getting to the bottom and understanding how these things are valued. And so I think that's and the overvaluation that very often results from a lot of the hype in certain sectors and certain companies as a result. So absolutely not formulaic, looking very much on a case-by-case basis. From my perspective, I tend to be looking more at, let's look at the business plan, let's look at exit time horizons, let's look at relative comparables in the public markets, recent M&A data points, and then let's work back from there in terms of what we think is reasonable. So that's very much the starting point for me, because I think you just have to be very clear as to what you're comparing it to. Just because X company went for 10 times revenues previously doesn't necessarily mean that the company in a different sector, a different country should be going at the same valuation.
Sure. And for you personally then, what kind of valuation range do you generally invest in?
In terms of the size of company? Mm-hmm. Yeah, to date it has typically been in the sort of, I would say, 2 to 10 million sterling range.
Okay, absolutely.
That sort of range.
And then we've dived into the middle section. So let's jump back a stage and talk about the early days of starting out as an angel. So what was the next step then? You decide to be an angel. Is it first building the network? Is it establishing a funnel for deal flow? How did you build out the platform to where you are today, almost?
Yeah, I think so. It's both of those, but I'll sort of touch on them both sort of separately. I think a great piece of advice someone gave me, who they've started their own business a while ago, for a very good friend of mine. Best piece of advice I've ever received was that a warning that the hardest thing when you make the transition, but that the phone will stop ringing. No one knows you. No one knows who you are, so therefore no one's going to pick up the phone and call you. And that's especially relevant when you think about someone coming out of an office environment, a wider industry where you're perhaps quite well known. People know who you are going to call you. So the phone stops ringing, and it's so absolutely building out that network was probably something I spent more time on than I expected. I talked earlier on about the positive surprise in terms of how generous people are with that, but it still takes a diligence to build that out and push that out. It's almost a case of saying, having a target in your own mind. Every person I meet or every person I speak to, let's try and get 2 meetings out of that. Or 2 introductions out of that to build sort of the exponential growth of the network. So that's absolutely has been was in the early days a big focus of mine and remains a big focus of mine. I think you can always improve the quality and develop the quality of your network. I think that's something we should always, I think, have at the forefront of our mind. And then the other point regarding the sort of funnel for deal flow, I think, and perhaps in all honesty, it's a reflection of my background, my industry background. But I very early on looked to set out what is my investment philosophy? What is my investment approach? Creating a due diligence checklist almost. These are the documents that I want to see. These are the conversations I need to have with the CEO, with the founder, with the potential lead investor. These are the things I need to do. And if I don't get any of these, or I don't get all of them to my satisfaction, then I shouldn't be doing the deal. And so I think with that, you begin to develop your investment criteria. And I think develop is this sort of key word there, in that it's an ongoing development. It's never right day one, and it can always improve it. But I think the proof to an extent is in the doing. So it's important that, what I found has been very helpful, and talking about it with friends, with other people invested in transactions, where it's almost, you do a transaction, take a step back and say, what worked well, what didn't work so well, what lessons have I learned? How can I get better at doing this? Because I think there's always, as I said, there's always that, you can always improve and you can always develop both your technical ability, your technical knowledge in the way you approach a transaction, but also that sort of gut instinct, if you like, as to, does this deal work or does this deal not work?
And talking about improving and learning from investments, can you reveal an investment, not obviously no names needed, but an investment that maybe didn't go quite to plan, and what you learned from it and how you've changed your strategy accordingly?
Yeah, I think there's like I said, I won't name names.
No, not at all.
I think one of the transactions I have done, I was probably, it's not, I don't regret doing it. I hope ultimately that it will work and work out for the investors and also for the founder. But I look at it, and I when I was going through the various risks that I saw in investing in a transaction, I downplayed in my own mind some of the risks, which actually have proven to be much bigger risks than I might have thought. I knew it was there staring at me. But I thought, well, actually, it'll be okay. It will be, and it's related to sort of commodity pricing. In sort of, given everything that's going on with oil and sort of other commodity pricing in the wider financial markets. So, I downplayed the importance of that as a factor in the company's business plan, and I probably should have given it more importance. And those things just serve as a reminder that you've got to identify the risks, but you've also got to think about them in the proper fashion and actually try and price that into that in the investment decision.
And so remind me, how long have you been investing now?
So I have been angel investing for the last 12 months.
Okay, so year in review. What have been the biggest takeaways for you? What have been the biggest pitfalls you faced in the journey?
I think the biggest pitfall, and I fell into this day one, was that you get access to deals and however you're accessing, whether that's from an online platform or from a network, and it's exciting, and you want to look at the deals, and you want to do the work, and so you have a conversation, whether that's on the phone or face to face at an event with the entrepreneur, and you're asking good questions, and you're excited about the opportunity, and the danger is you almost overcommit to your own time, but also the time of the entrepreneur, the guy who's actually wanting to raise the money, and so you kind of the risk is that you just bite off a lot more than you can chew. And I certainly fell into that trap very early on, where and it just comes down to enthusiasm. Mm-hmm. So it is a case of, I think, one of the things that I've noticed it in myself, I've become much, for want of a better phrase, much more brutal in just saying no. Mm-hmm. And I think that's the right approach. Say, if it's not going to work, you've got to be honest. If it's not going to work for you, say no early. It saves you time, but it also saves the entrepreneur time in having conversations with someone who ultimately possibly isn't going to get there.
And have you developed a framework for saying no then? Have you developed, you said quickly, but have you developed a structure for how to respond?
Where possible, I always want to do it face to face or on the phone. And I think being honest about why it doesn't work for me, and most of the time, it's not that it's an inherently bad company or a bad opportunity. It's just it might be that I don't understand it, and that's to me that is perfectly acceptable as a reason not to do a transaction. You've got to fully buy into the opportunity, and to do that you've got to understand the opportunity, and I think it's beholden on us, again, when we think about the sort of development of the sort of angel investing ecosystem. I think it's beholden on us as angels to be giving honest feedback to entrepreneurs. What works, what doesn't work. They themselves get better in how they approach investors in the future as well. So I think, I've certainly approached it in that sense, in that it's a two-way dialogue. I want the entrepreneur to challenge my view, and we might just agree to disagree, and that's fine as well. But I do view it as a sort of there's a longer term good there in having that approach.
And I'd love to dive into a quick fire round now. So I say a short statement and you hit me with your immediate thoughts.
Sure.
So your favourite book and why?
Favourite book? I am probably, to a fault, obsessed with mountains and the like. So almost anything mountaineering related, I love reading. Tales of trips up Everest or K2 or wherever it happens to be. So I do spend a lot of time reading books about mountains and mountain expeditions. And I think it's interesting because I think it has a lot of parallels with investing, and everyone wants the glory and they want the 10x exit, and that's fine when you get it, but you need to remember that underlying that and behind all of that, whether it's a 10x exit or you're going up Mount Everest, behind that there's a lot of training and planning and hard work that needs to go into it.
And then advice to first time angels, what would it be?
I think the biggest thing is get clear in your own mind what your methodology is. What are you doing? How are you approaching these deals? Look to improve it and improve your own skills as an investor, because you can always develop. And if you're in any doubt, say no. I strongly believe no has got to be the default answer for looking at these transactions.
The value add then that you're most likely to improve or gain as you progress as an investor?
So my focus is sciencey deals, specifically life sciences. I have my undergrad degree is in biochemistry, very stale scientific knowledge. I find it a fascinating area, and it's challenging intellectually and technically. So that's certainly something that I want to continue to develop. I need to continue to develop. I think that helps to develop relationships with entrepreneurs, and you move away from simply being a finance person or a capital provider into someone who perhaps has slightly more value add. So that's probably the biggest thing. It's not financial knowledge. It's technical industry knowledge.
And then your favourite startup or investing blog or newsletter?
I try and read a lot, and I think it's important that you continue to develop your own sort of industry knowledge and the like. And I think, as we said, the more you scratch the surface, the more you find out. But I think so rather than thinking about startup or or the like, there's biotech and money is probably one of my favourite. Blogs or websites. Wider industry, it's a great name, but also wider industry info, and again helps me to continue to build my technical knowledge, my wider industry knowledge.
Well, you're first for that one, so I'm writing it down. It's going in my reading list. And then overhyped and underhyped sector. What is it for you?
Overhyped and underhyped. Wow, that's a tough one. I'm almost certainly going to offend someone, but I think hype across all sectors is high. I'll try not to be too controversial. I think a lot of startups fail. Not telling you something you don't already know. And people need to remember this. I think simply sticking the word tech after an industry doesn't make it a great sector. And as a result of that, I am very cautious on fintech, particularly. Everyone seems to get very excited by fintech. I come out of the financial industry, or I'm in the financial industry, and it's not clear to me yet for a lot of these businesses what the success actually looks like, or success factors actually are. Mm-hmm. So I think that's one where I think it pays to be quite cautious on. Underhyped. Actually, we talk about, I talked about life sciences and that being a focus of mine. Something like biotech still in a lot of people's minds has a bad reputation from some of the issues that sector had in the late 90s, early 2000s. So I think that's one where actually it probably a lot of time goes under the radar screen a little bit.
I think it also goes under the radar because the barriers to entry for the investor in terms of intellectual knowledge is often very high in terms of, it does help dramatically to have a degree in science or biochemistry. So coming at it from an economics or a geography or history degree, I'm guessing isn't as helpful as it would be in other sectors.
Yeah, I think that's fair. I think that's absolutely fair. And I think as a result, you probably do see fewer people, be interested in looking at these transactions further. So I think that probably helped. They do, as you say, come under the radar screen a little bit more as a result of that. I think that's right.
And then I'd love to hear your most recent investment and why you said yes.
Yeah. I'm happy to name the name. A company called Smart Surgical. It has developed a number of different products in helping surgeons and the sort of surgical industry develop proprietary technology to help in keyhole surgery, effectively make keyhole surgery faster, more effective for surgeons. There's nothing out there comparable product for what it does. So absolutely the product meets a need. It's beyond the proof of concept stage, looking now for adoption by surgeons, hospitals, so perhaps slightly further along the line in terms of sort of product development. It hasn't got a product to market yet, but it's closer there than perhaps other startups we might see. But also importantly, the founder has started businesses before. It's not the first time he's done this. He's been successful. He's looking to use the company as a platform. It's not a single product company. He's not taking single product risk. So having that, I view it very much as investing in a platform of technologies, which I think has got an exciting future.
Well, David, thank you so much for joining us on the show today. It's been an absolute pleasure hearing your story.
Not at all, anytime. Thank you very much again for having me on.
And I'd like to give a huge hand to David for giving up his time today to share his pitfalls and successes of his first year angel investing. And if you'd like to read the accompanying article from the episode with David today, then head on over to the site at www.syndicateroom.com, or you can follow us on Twitter at SyndicateRoom. As always, it's been an absolute pleasure bringing you today's show, and we look so forward to bringing you next week's episode with Chris Schultz from Launchpad. And before we leave you today, let's tick those regulatory boxes and remind you that early stage investing is risky. Therefore, please ensure that you do engage in the proper due diligence prior to making the investment. Thank you so much and have a great week.